Okay folks, welcome back. I appreciate your patience. Yesterday I was expected to post a video on my YouTube channel, but real life got in the way. I had a family matter to attend to. So we're looking at a example of algorithmic theory. I'm going to talk a little bit about the Asian range and one of the caveats to using the Asian range, at least in my opinion. There is something about the Asian range that you need to be aware of, and obviously this is not the first time I've talked about this. My long-term viewers are familiar with this if they've been keeping notes. All right, so I've been counseling my students to anticipate and expect lower prices on the dollar. We have been looking at lowered prices for several months now on the dollar index, and it's been offering lower prices. And with that, we're going to assume that that bias would be still in play for our hindsight example. Now, obviously, if I'm lying, all of my students would come out in a rage and say, no, you were bullish on dollar. So we're going to have to go with a little bit of liberty here on my part. You have to just permit me this. The principle is if we're bearish dollar, we would be bullish on foreign currency. So the counterparty to a bearish dollar would be a potential bullish euro dollar. So without any more discussion about the dollar index specifically, let's take a look at the euro dollar. All right, so we have a intermediate term swing in the marketplace in here. And I want you to take a look at this run up right there. Okay, so this run up on price that takes out all of these relative equal highs. Above these highs would be buy side liquidity. That means there's buy stops there. Either buying on the breakout with traders expecting it's going to break out higher. Why would traders think that? Well, they've seen a rally up and a bull flag. So the market runs up, trips those traders long, and then aggressively moves lower. Traders that were trying to sell short with resistance ideas, they were tagged and their short has been nullified. So both sides are having their buy side liquidity attacked. We look at the run into these relative equal highs. When the market breaks down, we can look inside of this little formation right here. Okay, so this fractal. So the lowest candle is right there. All right, so we're going to take a look at inside that range right there, and we're going to drop into lower time frame, 15-minute, and we're going to take a closer look inside of that range. So let's drop into the 15-minute time frame. All right, so we have drilled down to a 15-minute time frame, and you can see the lowest down close candle prior to the run up. Now again, all of these relative equal highs, we see a run on stops there, and then it breaks lower. Your eye should be trained, and you do this with hindsight data. You teach yourself to see this pattern, and you will find that there's a lot of sensitivity to this particular level. So what I'm showing you is a very specific level in price action that you have to look at some logic behind it. It's not just simply looking at an old low, old high, and price turned here, price turned there, like support and resistance. There has to be some kind of context behind the level before you can have any faith in it, or at least that's what I teach. So the logic behind this is we want to look at the last down close candle prior to this run up that clears all the buy side liquidity. If the market trades lower than this low, this down close candle becomes my ICT bearish breaker. Okay, a bearish breaker. We're going to highlight the range of that candle right there. Okay, so now we're going to go forward, and I'm going to talk a little bit about this and how we can use it with day of week, Asian range, and we're going to implement some things, and we'll talk a little bit about order blocks also. This is an order block, but it is a bearish candle that if it trades up to it, it will many times offer a tradable setup. Now, what is a tradable setup? For me, that would be 15, 20 pips, something to that effect. Now, it doesn't always work. Nothing is absolutely 100%, but with the right context and some other things, it can provide you a way to trade as your own model. This is all a trader can use to find setups. It's not going to be appreciated the first time you see something like this, but if you go through your charts and study it, you're going to see that there are many times setups that form over a period of a month that you can find that offer 20, 30 pips, especially using the hourly and or 15-minute time frame. So we're going to scrub forward in time, and we're going to back out a little bit here. And you can see the market does in fact trade up into that today, and there's a resistance effect that takes place and drops lower. Now by itself, that's really cool. I mean, you don't need to see anything more, but I have more candy for you. But there is nothing more needed to really find a fascination with that breaker. But I'm going to give you some more context. We are now seeing on a 15-minute time frame another bearish breaker. See that? Relative equal highs, price breaks lower, and then runs up, clears out all the orders that would be resting right above here. So what do we do again? Our eye goes to the last down close candle right before the run up. This is your bearish breaker again. So we'll come back to that in a moment, but I want you to think about how extending with your imagination a line out in time from this candle's high, this candle's low, extend that out. Look at the sensitivity right in here. See that? Notice it does not go just to the bottoms of these candles here and then trade lower. It trades inside of this down close candle's range multiple times and then trades lower. I'm going to show you something regarding Fridays and Asian range. Now the Asian range, we can classify that as 7 p.m. to midnight New York time. Now I'm going to add some annotations, but before I do that, in your notes, in your study journal, if you're just watching this video like Netflix binge watching, then you're really not doing yourself any service. But whenever we're trading on Mondays, and this is one of the reasons why I don't like to trade on Mondays, so it doesn't mean I won't trade on Mondays. It just means one of the things that has to be in play and it has to fit, otherwise I won't trade on a Monday. The idea of the Asian range not being utilized on Mondays themselves. In other words, the Asian range that you would determine on Monday's data, in my school of thought, we do not consider that. And the reason why is the algorithm is actually going to look at Friday's Asian range. Now, my long-term viewers, they know this is true. It's been taught by me many, many years ago. And we've always referred to it when we talk about Mondays and or the Asian range. On Mondays, we refer to Friday's Asian range. So what we're saying is Thursday, 7 p.m. to midnight Friday Eastern Standard Time. So with that idea, we can take the Asian range that's on the previous week's Friday and utilize that to get projections on how far the market can build up into a specific level of resistance, but it has to overlap with some other narrative. And that narrative would be these two levels up here being that bearish breaker. So let's flesh this out a little bit. All right, so we've added the Friday Asian range the previous week, and I'm using the candles wicks and tails to illustrate how the classic view of the Asian range is interpreted. I do not always use the wicks and tails. I like to use the bodies of the candles, especially if they're very clear and discernible as they are here. And what do I mean by that? We're going to drop down till it gets to the highest close or highest opening price towards the end of the range on the high side. On the low end, we look here which one has the lower close or lower opening. So the close here is 18,002 and the open on this is 18,002. So we'll put our rectangle there. So there is our Asian range. All right, so we're using the previous Friday's Asian range for Monday's trading. So it is being utilized for this trading day. All right, so we have the delineation for Monday's trading, the 16th of November, and the previous Friday's Asian range. Now, what you want to do is start getting projections like this, and you can add out, and this is for the purpose of your study journal. And I'm going to speed this up. I'm not going to sit here and do this for each one, but this is essentially what you can do inside center there. All right, and then you're going to click clone and do the same thing, and all you're doing is just expanding this up and laying them right on top of the previous rectangle, and then changing the annotation to another Asian range. I'm going to speed this up, and we'll put this on the chart, and I'll continue. All right, so we have all of the Asian ranges stacked on top of one another, and you can see it goes right to the top of that high end of the breaker that we used as our initial narrative. So we have 1, 2, 3, 4, 5 Asian range projections on the upside that overlap exactly with a bearish ICT breaker. The levels are not just close. It's not just almost there. It's right there. Okay, it's right at the top end. So we have Asian range projections from the previous Friday used on Monday's trading. So what you're seeing here is the run up initially runs into the top of the bearish breaker and the Asian range that is stacked up. There's 5 of them. So there's 5 Asian range projections on the upside, and we have the bearish breaker. So the market trades there, and then from that point on, we see the market break lower, and then we have this same breaker idea on the 15-minute time frame. I'm just going to use a rectangle for this one just to speed things up. And we'll just change that to a red level. Okay. And so the market trades multiple times after breaking below this candle right there. That starts the breaker. So when it moves away, it comes back up. It's trading inside of this to mitigate all of the longs that were in here. Anyone that was long on a smart money level, in other words, traders on an institutional level that were long here that may have been caught off guard, they can now mitigate those positions. It's not that they're buying it to push it up. That's not what takes place here. Okay, that's not what goes on. This is repricing, and then this is mitigation. So all of this is the purpose of pairing up liquidity, buy side, sell side. So the market then breaks lower. What about this level down here makes it significant? Well, if you got to look at this price run in here. Now, I'm going to give you a moment to look at it. You tell me where there is a specific entry of volatility in all of this price run in here. Let your eye study all of that, and it should jump to a specific reaction in price. In other words, where is there a flurry of excitement? Right in here. Okay, this is displacement. So what we're doing is we're looking at it. So here's Sunday's data. We're going to kind of like blur that out for a moment. This is all Friday's trading. So Friday's trading, where is the displacement? In other words, where's the market really trying to show a willingness to go higher? Right here. So your eye goes right to this down close candle prior to this run up, because this displacement, the algorithm starts to run higher, and then it trades back lower into this turning point right here. So what you do is you want to take a level and put it right on the down close. Let me put this on that magnet so you can see it goes right on the high. And we'll change that to blue so it really pops. Okay, and we're cutting through all these candles. This is why I teach very adamantly that what I'm teaching is not supply and demand, because supply and demand says don't cut through candles. They demand, no pun intended, they require, they call it fresh levels. Well, there's nothing stale about this down close candle because it's my ICT bullish order block. It's just being reclaimed. So we have this specific price level here. It runs higher, creates an imbalance, it comes down, rebalances that, and trades right back into this bullish order block. Extend that through time, all the way through Sunday. We don't really care so much about Sunday's data. And then we have the bearish breaker that trades exactly into the bullish order block right there. Then price runs higher, trades back down into the last down close candle. So we have optimal trade entry here in the New York session. So remember what I started this video with. My students knew and have been focusing on a bearish dollar. I gave you a short little video clip on my YouTube channels in the story section. For whatever reason, it's easier for me to find the stories when I'm using my mobile. So in other words, if I log into YouTube using my phone, I can click on my logo, my ICT logo, when it's red. And if I click on that, it plays my story that I just recently uploaded. And the most recent one I did was a short little video, and it was showing the bullishness setup that was on last Tuesday on Eurodollar and projections that would lead to relative equal highs being taken out. Again, my students knew and have been focusing with me on bearish dollar. We're not flip-flopping around. We've been looking for bearish dollar. So we've been looking for bullish euro. I have not been wanting to trade British pound. So that way we know, in full disclosure, our focus as a group and community, we've been focusing on Eurodollar. So we have several components here. We have market running up into on Monday to a bearish breaker, and all of these Asian range overlapping. So the algorithm uses this range on the previous Friday when the bias is discernible. In other words, if we're bullish on the start of the week, as we have been in our community, euro should trade higher. It doesn't mean it will absolutely do so. It just means that we go in looking for things that line up to build evidence to structure a trade around a narrative that we anticipate. Okay, we're not guessing, we're not trying to catch up. Okay, we're not surprised. We're looking for things that are very systematic and they overlap to confirm a narrative. So this idea of projecting the Asian range is higher, it's a specific measurement the algorithm will reach for. Okay, it's not a Fibonacci sequence, it's not a Elliott wave thing, it's not something harmonic. It's a very generic mathematical utilization of a predetermined price range that is static. This range is static. It doesn't move around. It's a specific element of time when it begins and when it ends. We get the highest high, the lowest low, and or, as I like to use it, the bodies of the candles. Okay, so I like to look at the highest body and the lowest body. And that can either be the open or the close, whichever is the highest and lowest in deference to the range of the Asian range. Get that measurement and you project that up until it overlaps with another key level. The key level is that bearish breaker. It trades up into it here. Look at the precision, folks. It's beautiful. The top of the breaker comes in at 1.18682, and it was only off by half a pip because the high here comes in at 1.18687. So that's 5 pipettes, or 1/2 of 1 pip. Then it turns, creates the bearish breaker here, trades right down into a bullish order block. Your eye goes to this one because it shows displacement there. Now, it's not that every down close candle, like you see folks on YouTube They think they understand my order block theory, and it's not as easy as it may seem when you first look at it. Now, it's easy to go back in hindsight and say, here's where that order block was. And that's what, unfortunately, a lot of people do on YouTube. And that's why I get a little upset, because what they're doing with their audience is a disservice, because they're really not teaching anything. You're teaching them by default that every down close candle is a potential order block, when it's not. It is not. You need to have a displacement within a narrative. The narrative is we're bullish euro. Okay. We have been bearish dollar. We didn't just become bearish for this example. For weeks, we've been talking about the likelihood that dollar would go lower. So our bias has been on point. The reverse of that is a bullish foreign currency. And I have told my community, I'm not trying to trade cable. So what does that mean? If I'm not trying to trade cable, which is British pound versus the US dollar, and we are focusing on euro for study, all of our attention has been on this particular currency pair. So we look for levels that line up in logic to support the underlying narrative of a bearish dollar, bullish euro. So if we're bullish euro, we're going to start to use time elements that are algorithmic. The algorithmic principle of using the Asian range on a previous Friday and that of on Monday, we ignore it, because the Asian range on Mondays is skewed. We don't use it for any purposes like this. We have to revert to the previous week's range. Now, my question to you is, if the markets were not algorithmic and programmed to run to predetermined logical levels, then how on earth are these levels being so precise? And why does it matter with these ranges here? Because it's not random. If you do this and you study this over a year, okay, go back through and study when the market was bullish and bearish, and you'll have the context as I'm outlining here, because you don't have the benefit of the community that I have, where I've told them in advance that the dollar is bearish and foreign currency, in this case euro specifically, was bullish. So you don't have that. You have it only as a hindsight example, but I have thousands of people that sit with me and I outline this and I talk about how euro is bullish, dollar is bearish. And then you learn by taking the concepts that I teach and you plug them in to the price action. And over a period of time, seeing example after example, you learn by experience. There's no plug and play by watching a video. You have to plug yourself in front of a computer screen and study. It isn't an easy thing. It's not something that's going to happen for you real fast. It's complicated because you have to put in a lot of time and effort. But there's nothing like this, folks. There's no other school of thought. There is no other educator out there. There is no other trader out there. And I'm sitting here waiting for someone else to come out here and try to put their system or methodology against this, because they can't do it. They cannot do it. So if you're looking for things that are going to be highly precise, you're going to find that in my teachings. But you're not going to learn it real quick. That's why I operate a mentorship, because you're borrowing my experience, my foresight. When I look at the charts, I'm not guessing. I'm telling you as a community what it is that I anticipate. I'm pointing. And then you can go in and use the concepts that I teach and you'll see the setups forming. Now, what's interesting is, imagine for a moment that you were part of the community. If you were anticipating higher prices on euro, you could have used this scenario here to be a buyer in your studies on Friday of last week, and using this idea as a target, and you would hold over the weekend if you were inclined to feel that confident about it. And if it traded up to this level here, which is the bearish breaker, and all of these projected Asian ranges from the previous week, that would be a target, or just before it gets to that level, or maybe at the low end of the breaker, that would be a target. So between getting in here on optimal trade entry with a bullish order block and getting out at the low end of this range here on Monday, today's trading, that's a pretty decent price run for a short-term trade. Now, if you are a contrarian trader and you know that Mondays tend to be a consolidation retracement that sets up a continuation of a longer-term price move, we could look at this area here as a short-term contrarian short. And you can trade this right here when the anticipation it would trade back to this area here, which is highly sensitive. I mean, look at the bodies of the candles here. Yes, you have a small little tail here and a very small little tail on this one, but it's going basically back into this candle. The high of that candle comes in at 1.1815 and 1 pipette. The close on this candle comes in at 1.1815 and 1 pipette. It's real hard to get closer than that except for being perfect, and that right there, friends, is really, really precise. And the sensitivity there is this dynamic. The optimal trade entry, this gives you another trade here. So running back up into the breaker and maybe potentially running above this high, that could be a scenario here, but you would be taking logical scaling of partial position exits along the way. But count the number of trade setups just by looking at how the market swings and gyrates both directions. We have a long in here, potential short here, a long in here, and long in here. So there's multiple trades in here, and it depends on what your style of trading is. I don't force contrarian setups on my students. I don't force trend continuation on my students. I allow them to grow organically with the content and the concepts. You all may be looking at this and say, okay, I can see this setup, but I don't really see this one here as a short. And I don't see this one as a long. I don't see this as a sell. Some of you may see that as a sell. You see what I mean by that? I'm allowing the students to find their choice setup, their specific bread and butter setup. And whatever that setup is, once you gravitate towards it, you don't try to improve upon your trading by including something else. You latch on like a pit bull on a pork chop. You say, this is what is my setup. This is my model. And you work with that for a minimum of 6 months. And you're going to find that you know exactly what you're looking for because that pattern will repeat. And what do I mean by that? Well, this pattern here is the bearish breaker there. That's a short, trades down into this bullish order block right there. Okay, that's a setup. That's a sell. Just as well as this trade here to here is a sell, but based on this breaker. But you just have to wait for it to trade all the way up into it here. So this is the same pattern that is seen here. It just takes longer for this pattern to come into a setup where it's valid now. Until it gets to this level, this breaker is just something that's sitting and waiting. Now you may look at this and say, you know what, there's no way I would trade that. And maybe you're looking at this run here and saying, doesn't that negate that? No, just like I outlined here with the bullish order block there, we're cutting through candles. My order block theory does not have a limitation on you can't cut through candles. That's what supply and demand guys do. I'm not supply and demand. I'm looking at it like the algorithm does. The algorithm is going to remember these levels because it's significant. It's salient to what the price action is going to require to refer to on a near-term basis. And what I mean by that, when we're looking at price, OCD is flaring right there. It's got to look the way I want it, folks. I'm sorry. The price is going to refer back to specific levels that are key in reference to specific elements of time. Now, what I've given you here is a lesson that really builds on what I've taught in the past regarding Asian range not being used on Mondays, but using the previous Friday's Asian range. So you can see that this is not a contrived, form-fitted thing. It fits all of the logic that I've taught with the previous discussion with Asian range and with that of Friday's data, not Monday. So in your journals, you want to make a notation that on Mondays, we do not refer to Asian range. It's not important. It's not crucial. It's not required to find precision. You use the previous Friday. Now, the caveat to that is the Friday's Asian range is only useful if a bias is underway. That means, are we in a buy program or a sell program? What is a buy program? Buy program is simply we're in a bullish market and it's probably going to keep going higher. If we're in a sell program, then that means that the market's moving lower and it's probably going to continue moving lower. So we would use the Asian range in a bear scenario. We would project the Asian range lower to get potential overlapping with a key level like I've outlined here with the bearish breaker. The patterns themselves are repeating on different time frames, just like this one here is a reaction in the bearish breaker by scrolling back to the left as I shown, or you can trade it on a smaller one here where it just creates in the near term price action, hits it, and then offers a trade there as well. So it's a matter of understanding what it is you want to trade with the things that I teach and trying not to apply every possible moving part that's available in my library. Now, what I just showed you here is multiple models in and of itself. Any one of these could be your setup, but using all of this idea to frame out a narrative. And I know some of you are thinking, well, this isn't easy like I thought it was going to be, like overbought, oversold, divergence. Well, right. I promised it was going to be expensive. Things like this and this precise aren't going to be easy. It's going to require a lot of thought. And that's the reason why people go on YouTube and they try to teach things in hindsight, because they cannot do, they haven't submitted to learning it yet. Now I have students that are extremely versed in my concepts and they have found their unique model and they do very, very well. They're not making YouTube channels and trying to make a name for themselves. Okay. The mentorship, I teach you how to be an independent thinker. You have the benefit of me pointing to where I think the market's going to go. And then it kind of like gives you the insight of, okay, if I was bearish, let me focus on the bullish side, because if ICT is saying he's looking at a level above us, then I'm really arm wrestling almost 3 decades of experience. I'm not saying that I'm not wrong once in a while, but it's really rare. So forget the fact that it might sound egotistical. Forget the fact that it sounds like I'm bragging, because I'm not. I'm just trying to give you the picture of what it's like being in the community. But you have to go into the charts yourselves and find the setup that you like. Now, in the beginning, for months, you're going to be feeling like you're not learning anything, because you're getting new concepts, new learning, and me pointing to where the market's going. And when the markets go there, you're going to feel frustrated because you're not trading these setups. And you're going to want to send me emails like thousands of people in the past have done and say, I feel like I don't know what I'm doing. I see what you're saying and I see the lessons and I appreciate all this, but I'm not able to find a setup. Well, that's what you're not supposed to be doing. While you're in mentorship, you're not supposed to be trading. Everyone wants to come into mentorship and try to start making money right away. And that's how they mess up, because they cheat themselves out of the learning and the development process that is aimed to be available to each student when they first start. So what am I saying? For an entire year, you should not be trying to take a trade. And if that's what you are dying to come into the mentorship for, save your money, don't join, because you're going to hurt yourself and your development by doing that. It would be better for you to just stay in the free content here on this YouTube channel and don't send me any money. Don't try to join the mentorship, because you're only going to get frustrated because you won't have the patience to follow along with the process that I outline. When is it realistic for you to anticipate you knowing what your model might be? I've had people come in by the 3rd month say, man, this is it. This helped me figure out exactly what I'm doing. They stayed throughout the content and where they're at charter membership level now, but they still say, I've learned what I wanted to learn on month 3. Now, I'm not stating that people coming in at month 3 will know everything they need to know, but these are individuals that have been with me for years and years. And then finally that one little thing clicked and it made sense to them. Everything fell into one place where they have a model now. I tell everyone that you need to go through the full year, because you're going to see a full calendar year with seasonal tendencies, influences, and all the factors that go along with it. And I draw in all other market asset classes to tie it together. Once you have a full year under your belt, then after that, you're a charter member. Then you spend 6 months, assuming you've figured out your model. Then you spend 6 months with that specific model. You will know if you are on the right path after 6 months working with one specific model. Now you can see that I did not bring in commitment of traders. I did not bring in SMT. I didn't need all that stuff. You don't need it either. All they do is help qualify a setup. Now, your model may require SMT. It may require commitment of traders to trade on that side of the marketplace. And there's nothing wrong with that. That's just a filter, okay? But when you really know what you're looking for, you don't need to have all those things. And that's what the mentorship teaches you. It teaches you how to take the right pieces over time within the context that I'm outlining each week. And I say, okay, I think we're going here. And then you know, okay, I'm going to go in and use these tools that favor trading the market that side. But you're not trading with live funds because you need to learn to trust the analysis concepts and also trust yourself. Learn patience. It's a lot of things internally that most people that come to me think it's not going to be a problem. And it is a problem for many people. Humans don't have patience. And you want, because you're paying me, you want it to be fast. You want to learn how to make money right now. And I'm telling you, you need to wait. Not because I can't teach you how to do it, but because you need to learn how to remove all these barriers that you're not even aware that you have yet. So hopefully you got something from this, and hopefully it didn't sound too much like a selling or pitch for mentorship. I'm just answering a lot of questions I get and giving you an idea of things that you can learn right from this YouTube channel and not have to pay me. But if you want to be a part of the community, I'm kind of like giving you an X-ray view of what it is that we do and how it is it's provided to you. So with that, I wish you a pleasant week. Be safe. And again, go to my community tab. I posted a really important post and it was intended from the heart. And I think you should follow the instructions I gave you there. Until I talk to you next time, be safe.